Welcome to Talk Tickers. Today, we're digging into Asana's third quarter earnings for fiscal 26. This is a really big one. It's only the second report from the new CEO, Dan Rogers, and it's a pivotal moment for the company. They're trying to pull off this tricky balancing act between disciplined profitability and a really ambitious AI strategy. So let's get right into it. So the stock popped a bit after the numbers dropped, which is great, but let's be real, after a full year of seriously underperforming its peers and a huge change in leadership, the big question on every investor's mind is pretty simple. Is this the real deal? Is this the start of a genuine turnaround, or is it just a temporary bounce in what could be a longer-term trap? Okay, so let's start with the headline numbers, because on the surface, this was a pretty strong quarter. Asana delivered a solid beat on what analysts were expecting, and maybe more importantly, they confidently raised their guidance for the full year. As you can see, the company managed to beat on both the top and the bottom lines. Revenue came in at $201 million. That's a 9% jump year over year, while non-GAAP earnings per share hit 7 cents, just edging out what the street was looking for.
And management put their money where their mouth is by raising their guidance. They tightened the range and lifted the high end of their outlook for the entire year, for both revenue and EPS. That's a clear signal of confidence that they think this positive momentum is going to continue.
So, how did the market react to all this? Well, with some cautious optimism. The stock climbed almost 5% in after-hours trading. Now, while any green arrow is a positive move, here's a little context for you. Options traders had actually priced in a much bigger swing, something like 13 to 14%. So, what does that tell you? It tells you the result was seen as solid, for sure, but maybe not the explosive, game-changing quarter some had been betting on.
All right, so if the numbers themselves were just solid, what's the story that management is trying to sell to Wall Street right now? It's a very, very clear pivot. It's all about two things: disciplined financial execution and a highly differentiated AI strategy. The new CEO, Dan Rogers, he's making a really bold pitch here. He is working overtime to shift the perception of Asana from being just another task management tool, another to-do list app, into being a fundamental core platform for how humans and AI actually work together. The goal is to move way beyond simple productivity hacks and really embed Asana into the mission-critical workflows of big companies. And they're framing their unique advantage around what they're calling the 3 C's. First, you've got context, which comes from their proprietary work graph, so the AI actually knows who does what and why. Second, checkpoints, making sure that humans are always in the loop to approve things. And third, controls, to ensure enterprise-grade security. The whole argument here is that most corporate AI projects are failing because they just lack this kind of deep foundational structure. Okay, so a big AI vision is great, but how do you pay for it? Well, that's where this very real efficiency story comes in. The company delivered a massive 12-point swing in its non-GAAP operating margin compared to last year, and they generated over $13 million in positive free cash flow. So this isn't just talk. They are actively reallocating their spending and optimizing costs specifically to fuel that AI roadmap. And this right here brings us to the core dilemma for any investor looking at Asana right now. It's this tension, this conflict between this really compelling new story management is telling and some of the underlying numbers that are, frankly, less impressive. The bull case is clear, right? The pivot to profitability is absolutely working. Growth in large, high-paying customers is strong, and that AI vision is compelling. But the bear case is just as potent. Top-line revenue growth is still kind of sluggish at 9%, and crucially, their dollar-based net retention is still hanging around 96%. Now, what that means is that the average existing customer is actually spending slightly less than they were a year ago, and that is a key sign of underlying weakness. In this chart, wow, this really puts the whole challenge into perspective. Even with this positive quarter, Asana's stock has fallen 11% over the past year. At the same time, the broader software index, the IGV, is up almost 30%. That is a huge gap. The company has a ton of ground to make up just to get back in line with its peers. So when you put all of that together, you've got the solid quarter, the compelling story, but also those lingering concerns in the metrics and the stock's underperformance. What's our call on Asana going forward? We are initiating coverage with a market perform rating. So what does that actually mean? It means we expect the stock to perform roughly in line with the rest of the software sector over the next year. In our view, the risk and the reward from here, they're pretty well balanced. So here's the bottom line. The operational turnaround is real and it's impressive. Those margin gains are locked in.
But, and this is a big but, we believe the good news is now largely priced into the stock. The next leg up for the stock has to come from growth reaccelerating, driven by that AI strategy. And that part of the story, well, it's just not proven in the numbers yet. All right, finally, let's talk about a potential trade idea. How might an investor actually play this situation from here? The idea here is what's known as a pairs trade. You go long Asana stock, but at the same time, you short the IGV software ETF. The whole point is to try and isolate Asana's company-specific potential. See, if their AI strategy really hits and growth takes off, you capture that upside. But if the entire software sector sells off because of macro fears, your short position in the IGV should give you a hedge. And the key catalyst you have to watch for this trade to work? Dollar-based net retention finally crossing back above that 100% mark. So to wrap it all up, the new leadership at Asana has laid a really solid foundation for a new chapter, one that's focused on profitable growth and AI. But the turnaround story absolutely remains on trial, with the market waiting and watching for definitive proof of a growth revival. This is not financial advice.